Welcome back to Alpha Recap, Energetic Friday edition. We're unpacking the tape from the close and looking ahead to the long weekend. As always, if you have questions, you can reach us at stockalpha.ai and use the Q&A feature to ask directly.
Good to be here. Today's session felt like a three-act play. Big cap technical setups, a Fed probe into private credit, and wild microcap moves. Lots to chew on.
Right, and markets were closed on Saturday, April 11th, and set to reopen Monday, April 13th. So all of this is in the rear view for the trading day. We closed the week with a pretty bifurcated story.
Exactly. On one side, you had constructive technical buy zones in large cap tech, names like Google, Amazon, and Nvidia, where momentum technicians were pointing to lower risk entries. On the other, rising event risk from politics and regulation and a parade of tiny cap wild moves.
Let's break that down. First, the buy zones. When analysts say a stock is in a technical buy zone, what did they mean in plain English?
They mean the price was sitting at levels where multiple indicators lined up, like support, moving averages, and momentum signals. It's basically a range where trend followers view the trade as having more favorable odds and lower implied risk.
So, what really stands out here is that momentum had carried those mega cap names into ranges that looked like potential entry points after recent rallies.
Right, but, and this is key, analysts flagged that headline risk could blow those setups apart. Earnings, geopolitical news, even weekend headlines could produce gap moves that invalidate a technical setup pretty quickly.
So, opportunity, yes, but not a clean runway. Which brings us to the second big story, the Fed probe into private credit.
The number that really caught our eye was the estimated size of private credit, about $1.8 trillion. The Fed is trying to understand how redemptions and liquidity stress in that market could transmit to banks.
And in plain terms, private credit funds lend to mid-market companies and don't trade their loans easily. So if investors try to pull money quickly, managers can't sell into deep markets without big haircuts, which can ripple into banks if they're connected.
Exactly. These funds are illiquid by design. Rising redemptions can force funds to slow redemptions, sell into thin markets, or lean on bank facilities, which raises second-order risks for banks and credit markets.
Yeah, that tracks.
And analysts broadly agree the probe increases uncertainty for banks and investors with exposure to private credit. So this isn't just arcane paperwork. It's a potential macro-financial channel.
Let's pivot to the microcap chaos. Friday's tape had some wild one-day percent moves in sub-dollar names.
We saw real dispersion. For example, WGRX surged about 13% to 12 cents on heavy volume, roughly 210 million shares. That suggests genuine trader participation.
Contrast that with ALCYW, which spiked about 61% to 21 cents on 3 shares. That's mechanical volatility, not necessarily a signal of demand.
Right. And then there were dramatic drops. One name fell about 37% to 10 cents on only about 1,800 shares. Another dropped about 39% on just 615 shares. These illustrate execution and liquidity risk in penny stocks.
Not a great day for anyone trying to trade those thin names without a plan.
Exactly. Screens that flag big percentage moves can be misleading if volume is tiny. You need context, traded size, news catalysts, and whether a move is driven by block trades, short squeezes, or actual retail demand.
Quick reactions, short segment.
Block trades can mask real flow.
Low volume equals wide spreads and slippage.
Exactly. Tiny trades can wildly swing prices.
Okay, shifting gears. Analysts broadly agreed on a few things. Headline risk is elevated, the Fed probe matters, and microcap liquidity was a mess. But they diverged on tone.
Right. Technical analysts were relatively optimistic on those large-cap tech buy zones. Macro and policy folks were more cautious, pointing to earnings and diplomacy around Iran as volatility catalysts that could test technicals.
It's that age-old trade-off. Favorable technical setup versus event-driven risk. And spelling that out matters depending on your horizon.
Which brings us to investor implications. Let's walk through how different participants might have interpreted Friday's action.
Long-term allocators. This looked more like a near-term volatility event than a strategic regime change. The Fed probe deserves attention for institutions with private credit exposure, but long-horizon fundamentals remain the guiding force for allocation.
Active traders and tactical managers. This was a mixed bag. The buy zones in Google, Amazon, and Nvidia offered setups for momentum strategies, but the elevated headline risk meant more potential for gaps and whipsaws. Discipline mattered.
Fixed income and credit investors saw a clear signal. Reassess liquidity assumptions in private credit allocations. Funds that promise limited liquidity are vulnerable to redemption shocks and forced sales. That changes stress tests.
And for retail and speculative traders, the microcap moves were a reminder to check volumes. A big percent print without volume can be expensive to trade because of slippage and spreads.
So what were the concrete things to watch over the weekend and into Monday?
Headline flow on Iran diplomacy and any congressional developments tied to the oversight hearings. Also, follow-ups on the Fed probe. Any statements from regulators or banks could shift sentiment into Monday's open.
And for the tech names in buy zones, monitor any earnings pre-announcements or guidance changes. Those could validate or invalidate technical setups heading into the week.
Finally, watch pre-market liquidity and tape behavior in the microcap names that moved hard. Low liquidity names can gap and remain illiquid for some time.
Let's cover practical, non-actionable risk management notes. Position sizing relative to liquidity was top of list.
Yes, use limit orders in thin markets to control execution cost, validate large percentage moves with traded volume, and stress test credit exposures for forced selling scenarios if you have private credit links.
I mean, when you step back and look at this, the recurring lesson is context. Volume, news, and structure, they change how you read a price move.
Agreed. And to add to that, analysts were largely in consensus on the elevated headline risk, but they diverged on whether to be opportunistic in tech or defensive given the event calendar.
Quick 3-point recap before we close. 1. Megacap tech showed technical buy zones that technicians liked. 2. The Fed's private credit probe highlighted a liquidity transmission risk tied to about $1.8 trillion of assets. 3. Microcaps were volatile and often illiquid. Volume mattered more than percent moves.
Bottom line, Friday's tape left the market in guarded optimism. Technical momentum at the top end versus headline and liquidity risk elsewhere. Momentum could persist, or headlines could trigger reassessments when trading resumed on Monday, April 13th.
Investment disclaimer. This analysis is for informational purposes only. It does not constitute a recommendation to buy, sell, or hold any security, and it is not personalized investment advice. Analysts' sentiment labels reflect market analysis, not investment instructions.
If you want to dig into any of these names, or ask about the private credit dynamics or microcap quirks, head to stockalpha.ai and use the Q&A feature. We'll answer live and follow up with deeper notes.
For more market analysis and ongoing coverage, visit stockalpha.ai. Thanks for listening to Alpha Recap. Have a good weekend, and we'll see you when markets reopen on Monday, April 13th.